My dear friends, welcome to Raja Sekar classes. This is lecture number 24. In this lecture, we will try to understand debt to equity ratio. Before discussing debt to equity ratio, let me recall what we discussed in our previous lecture, that is lecture number 23. We were discussing about efficiency ratios. Just for the sake of the completeness, I kept this particular slide. Just go through. There are different efficiency ratios: inventory turnover, asset turnover, receivable turnover, day sales outstanding. Now, as of now, they are not that relevant. That's why just let me proceed further. If it is required, I will discuss about these ratios in future classes. Now let me continue my discussion on solvency ratios. What is the solvency ratios? These ratios are crucial for assessing whether a business can continue its operations without financial difficulties or the risk of bankruptcy. Actually, these are debt to equity ratio, debt to assets ratio, equity ratio, interest coverage ratio, debt service coverage ratio, cash flow to debt ratio. These ratios comes under solvency ratios, in which we will try to understand first three ratios. Anyway, let me discuss first ratio, that is debt to equity ratio. What is this debt to equity ratio? If you see the definition, debt to equity ratio is total debt by total equity. What is this total debt? Total debt includes all short-term and long-term liabilities such as loans, bonds, and other financial obligations. What is this total equity? Total equity represents the shareholders' equity, which includes retained earnings and stock investments by shareholders. Why? Actually, let me consider one simple example. Let me say if a company has this much for debt, and how can I calculate debt to equity ratio is total debt by total equity. Just I'm keeping that numbers, I'm substituting, I'm getting debt to equity. It's elementary class problem. I'm getting 0.5. What is the meaning? What does it mean? What's its interpretation? This means company has 50 cents of debt for every dollar of equity, isn't it? What importance of debt to equity ratio? Why it matters? It evaluates financial risk and stability. It helps investors and creditors assess a company's ability to meet financial obligations. It's a risk indicator. High debt to equity ratio signals higher financial risk. Investor confidence, low D by E, low debt to equity ratios may attract conservative investors. Industry benchmarking, I can say it helps compare companies within the same industry. What are the implications? High ratio reliance on debt financing, low ratio reliance on equity financing. Ideal debt to equity ratio. The ideal debt to equity ratio varies depending on industry, business model, and market conditions. What are the industry benchmarks? Manufacturing 1.0 to 2.0, technology 0.5 to 1.5, finance services higher ratios may be acceptable. Financial health indicators below 1. Actually, this you can understand capital incentive, capital intensive industries, capital intensive in the sense manufacturing, utilities, telecommunication. I request you to go through these 2 points. What happens in the case of capital intensive industries, and another one is technology or service based industries, lower D by E ratios, isn't it? Actually, what it says, but I can say financial health indicators. Below one indicates more equity than debt, which is generally safer, but could also suggest under leveraging. About 2 or 3 can signal higher financial risk, especially in non-capital intensive sectors, as the company may struggle to meet debt obligations. What are the conclusion? What are the key takeaways? The D by E ratio is crucial tool for assessing financial health. It context really matters. Context matters. Always consider industry norms and company specific factors. Balance is the key. Excessive debt can lead to instability. I request you to go through this lecture